Why are working capital lines so important? Well, working capital lines are so important because that's the cash flow of your business, right? It all comes down to cash flow. So the more cash flow you have, the easier it is to expand the business. When a business is suffering because they're not having strong cash flow, meaning things are coming up short or you're having trouble paying bills, making payroll, that's when you start seeing a lot of things deteriorate in the business, right? You either have to lay people off, you start bouncing checks, you get behind with vendors, right? So cash flow is the lifeblood of any business. Here's what I would tell you. Working capital lines are great to use when you're trying to build the business and when you're trying to expand and grow. I would never tell someone to use a working capital line to keep the business afloat if the business is failing and there is no plan to turn it around. Now, if there's a plan to turn it around and you're pretty sure that it's going to work because you're going to try something different, that's a good time to use it. Also, another good thing to do is if you know you're having trouble with the business, but bringing on somebody that can help, somebody that can pick up the pieces and pick up the slack where you're weak, right? Maybe it's somebody that's a pro in marketing. That would be a good addition at that time. Now, you can hire them or they can buy in for equity. The challenge that you're going to have is if the business is struggling, you're going to sell a lot of your company for a small amount of money. And what I would say is if it makes sense to do, if they really add that much value, you rather have a smaller piece of a large pie than all of a very small pie. Now, let's get into working capital lines. Working capital lines, let's say your credit isn't where it needs to be, using a working capital line to expand into marketing, to expand for equipment, to expand for inventory, for supplies, to add staff, that makes sense. What you need to really think about is, how is that going to help your business grow? If you get a piece of equipment, are you going to be able to do another 10% more a month, right? And then you need to compare, is that 10% you're doing, let's say you're doing $50,000, doing 10% more a month, that's going to be another $5,000 a month. That working capital line, what's the payment of it each month? So if you're paying $3,000 back to that working capital line and you're bringing in an additional $5,000 from getting that piece of equipment that you normally wouldn't have had, well, you're increasing your cash flow by $2,000 a month. Once that working capital line is paid off, all that upside, that whole $5,000 is yours. In that scenario, it makes sense. Same thing with marketing. If in that same scenario, you use the money for marketing and you expect a 10% increase in sales, well, now you're doing, even more. So that's where you'd be doing an additional $5,000 a month. That matters, okay? If you use it to add staff, right? Adding staff or adding to your team, one, it'll make the business more efficient, and two, maybe you can actually work on the business and not in the business, right? And you taking a step back and running it from a bird's eye view instead of you being the janitor, being person that's gonna unclog the toilet, the person that's taking care of every little thing. If you can take a step back and run the business and work on the business instead of in the business, your business is gonna get a lot further. So that could be a huge benefit. That in and of itself, you could see increases in your cash flow, right? So what you have to compare is what's the increase in cash flow versus how much you have to pay a month for that working capital line. Very few times when a business is failing, I suggest taking out funds. The reason is you don't want to go into debt and basically throw good money after bad, to save a business if there's something fundamentally wrong with the business. I know most people in my space would say, take the money and try and turn it around. Right? If you have a plan, that's great. Now, there are a few cases where it does make sense. Let's say your business is doing really well, and then all of a sudden you have a tax lien from the IRS because your accountant messed up, and essentially, you didn't pay enough in taxes, and now you have a $75,000 tax lien that hurt your credit. Well, if you're going to borrow a working capital line to clear that up because you don't have $75,000 laying around in the bank, and that's going to shoot up your credit score, well, that's worth doing, right? There are certain things, if you can get ahead of, meaning before you get penalties, interest, and fees from the IRS, that makes sense to me, right? So the biggest thing when you're analyzing a working capital line, because working capital lines are typically going to be shorter term, they're going to be daily or weekly, very few, if any, are monthly. So most of them are daily, weekly, or out of the credit card sales of your business. They're more expensive, right? They're shorter term, they're more expensive. You need to analyze what you're using those funds for is going to help your business, how much your business is going to grow by using those funds, and compare it to, one, increasing cash flow versus the payment, right? So if you have a higher increase in cash flow than what the payment is, you're going to be cash flow positive on it. That's worth doing. The other thing you need to factor in is how much additional profit are you making after you consider the cost of the capital, right? So if the $50,000 is going to cost you $65 total, meaning there's a cost of capital of $15,000 on the $50,000 you're borrowing or being advanced in this working capital line, are you able to make over that $15,000 in cost of capital, right? So if you do something that you're going to invest in, so if you buy a piece of equipment and you do an extra $5,000 a month with that equipment, and your profit margins are, call it 50%, and that money's out over the course of a year, just simple math here, right? You're talking about making an additional $30,000 in profit, okay? The way I got to that was you're doing an additional $5,000 a month, it's $60,000 a year. If you have 50% profit margins, 60,000 divided by 2 is 30,000. When you compare that 30,000 that you're making now to the 15,000 that you're paying, right? There's a significant ROI. So you're making an additional $15,000 in profit, not to mention increasing your cash flow. In that situation, using that working capital line makes sense. This is why working capital lines are so important, because you might not have the time in business, you might not have the credit that you need, right, to get into a line of credit or an SBA loan. All right, so this gives you the money to help improve and grow and scale your business. Another thing that I would tell you is a lot of our clients, if they go the working capital route, you need to figure out how to get out of that working capital cycle. What I mean by that is there are certain times to use it. You don't want to continuously use working capital lines though. So if credit is a big issue, you should use some of that working capital line to pay down your credit cards. You should use some of that to pay whatever you need to pay to get into a credit repair program to improve your credit. So next time around, we can work on an SBA loan, we can work on a line of credit, we can work on equipment financing. So you should always understand why you have to use that working capital. Sometimes it's speed, right? Working capital lines are typically faster and easier to get done than most programs. So maybe it's a speed thing. Maybe next time you're a little bit more prepared before you need financing. But I'll tell you this, lines of credit work just as fast. So it shouldn't really be about speed. You need to make sure that your credit is where it needs to be, your cash flow is where it needs to be, and your time in business is, over a year, so you can get into some of those better programs that we discussed. Again, working capital lines are very, very important. I've had clients that started with me and they were doing $125,000 a month, and I've gotten them probably close to $7 million now over the last 6 years, and he's grown his business. He's doing $1 million a month. He prefers that because they'll give him $500,000, $750,000 at a clip because he qualifies for it, and what he does is he goes out, he hires drivers, buys trucks, even though he can qualify for those other programs, like we've gotten him equipment financing. And he's successfully used those lines to grow his business. He 10x'd his business. So they are great programs. You have to use them properly. If you guys have any questions about the program or anything else in regards to building your business, go to integratedbusinessfinancing.com or reach out to us directly. We'll be happy to help you.